And welcome out to the Tackle Trading's halftime report. It is March 5th, 2020. Man, I almost said 2019. Even in March, I'm still almost saying 2019.
I've actually done that recently myself, actually.
It's terrible. When you're writing dates, it just becomes a 19. It's like crap. So it's always just a scribbled 20 over the 19. But I got myself, I got Matt, and I got Mark here with us. How are y'all doing today?
You know, I'm doing actually really, really good. Although I did get something in my eye and I can't get it out, and it's driving me absolutely crazy. And I think now my right eye is all red. People are going to think I have coronavirus.
Well, it's not an eye disease, but okay.
Yeah, but does people know that?
No, they don't.
We were literally in the pre-production show, we were all talking about the ignorance of the American populace regarding this situation. So who knows?
The one thing we all agree on is that the American populace is a little bit ignorant to the situation, so they're fearful.
Yeah, well, isn't that what causes a lot of fear in the first place, though, is just lack of understanding of something?
Absolutely. That's probably the root of all fears is unknown. Something as simple as, being scared of the dark. Why? Because you can't see. It's unnatural. You don't know what's out there.
Yeah.
When you're worried about your kids and you're afraid they're going to get hurt. Why? Because it's unknown. The fear of unknown is like the root of, I would say, just about all, if not all,
just about everything
fears there are.
I fear flying because I don't understand how the plane works, or whatever the case might be. But I do think that's causing a lot of the panic within some of the U.S. It's just a lack of understanding of how this actually works, and so on and so forth. But yeah, Cody, I'm doing good. I'm excited to be here with the halftime crew. And last night we did a mastermind group on the Tackle 25, and me and Coach M, we had a lot of fun last night. We went about an hour and a half last night, and talking about how to manage this downside risk. And a lot of times when you're doing covered calls and you're writing those covered calls, it's a natural hedge against markets going down. So we had a lot of fun on the mastermind group for the Tackle 25 last night.
Very, very nice. I missed it. I'm gonna have to catch the replay then and check it out. Matt, do you have a camera so the audience can see your beautiful face?
I do, but my eye's all red.
Oh, so you don't want to show it?
Yeah, like literally, I don't want to be rubbing my eye the entire time, because that's what I feel like I need to do. So I'm in the bunker.
That's probably what's irritating it in the first place. So whether it's an eyelash or dirt,
it's not an eyelash. I'm going to tell you that. It's been going on for 4 straight hours. It's driving me nuts. But that doesn't have anything to do with the market going down. Well, actually, that would be a natural headline. Market goes down because Matt's eye is hurt.
No, everyone knows, Matt, market is going down now because Bernie Sanders is no longer going to be president, and the market is freaked out that Bernie's not going to be president, so it's going down now.
Oh my God! All the headlines that are trying to say this president and that president are the reason the market's up or down. It's all ridiculous.
The nonsense I've heard over the last 2 weeks about Bernie Sanders impacting the stock market,
or Biden, or this, whatever.
Bernie not being president is why the market's going down to Nick. I mean, like.
Well, I did love it when Bernie was surging, how the market was going up when Bernie was surging, and everyone was like, the market's going up because Bernie can't beat Trump, and so it's a guarantee for 4 more years of Trump. And then when Biden, takes the lead out of Virginia, and obviously it's Super Tuesday, market's going up because Bernie's not going to get the nomination. It's silly headlines, just silly headlines.
Oh yeah, absolutely. They literally try to pick whatever's in the news, whether it even affects the market or touches the market, and claim that that's why the market's done what the market's done.
Oh yeah,
it doesn't make sense. Like maybe just once, I want to see a headline where it says like, market moving up today after bullish retracement. It's like, okay, yeah, that makes sense.
How about just tell the truth? Market goes up because algorithms. like seriously. But the reality of the situation is the market is just simply trying to understand the extent of this situation with the coronavirus. We see positive headlines on a daily basis. We see negative headlines on a daily basis. And really the market's going to be volatile, and it's going to be volatile on a daily basis. And we need to get prepared for that.
Yeah. I have no idea which way this market's going to go in the next 2 weeks, if not even next 2 days. But all I do know is in the next
I know
20
where the
years,
market's
20
going to go in the
years.
next 30 minutes.
Yeah, that's awesome. Well, the next 30 minutes, I have a pretty good clue. I mean,
so do I, because you're breaking intraday support levels. I mean,
absolutely.
that's the only thing that, and anybody who says this is a great buying opportunity or this is a great selling opportunity on the long term, they're not understanding how this actually works, right? It's just there's too much uncertainty from how this is going to impact from an economic perspective for the market to truly price anything in right now. There's just too many uncertainties.
I just thought of the quote from, what was it, Wolf of Wall Street, Matthew McConaughey. He was like, no one, especially stockbrokers, know where the market's going to go, up, down, or in circles.
Well, I think the circles.
He said a little colorful language, but I'm not going to say that colorful language.
The colorful language is what makes that seem really good.
It does.
You know, but looking at this market from a technical perspective, obviously, you know, the market surged yesterday, came into that 3100 handle, kind of slowed down a little bit at that 31 handle. And when you're looking at the intraday perspective, you kind of see this coming into those resistance levels right there around that 3100. And then obviously, as the market closed, you know, we had a surge coming into the market close yesterday. But then once the overnight action happened, once the market closed, you really kind of see that movement take hold here. And now after the cash open here, obviously, you're seeing that market break that support level of 3040. And, you know, it's just from a technical perspective, you got to say the market's going to see that 3000 handle probably before we even get done talking today.
Well, I mean, that's the one thing in the last 2 weeks that we have known, is that when intraday support or intraday resistance breaks, I mean, you look yesterday, there was a little nice resistance formed while we were doing the halftime report.
Right here.
Really clear. It breaks out. And when intraday resistance or intraday support has broken, and this is for 2 weeks now, you have seen massive moves in short amount of time when those resistance and support areas have broke. And so, like, you know, when you have a support levels break, you know, it's just like you hope that something catches. If you're a bull, if you're looking at your 401k, you're like, and then you enter hope mode.
Yeah, hope isn't a strategy.
Because you now no longer have anything technically holding it up on a short-term intraday basis, and you're like, okay, revert. I mean, this is what people do. They look at charts and they say reverse, and they're hoping and hoping and hoping. Well, the plain and simple fact is, for 2 weeks, support and resistance on an intraday basis, when you have multiple tests of those levels, have provided. And once again, nothing is ever 100% in trading, but boy, they've been pretty dang good over the last 2 weeks in predicting where short-term price movement the rest of the day is going to go.
I think the best metaphor I've heard is screaming at the market or hoping or getting angry as you're watching the chart and, you know, your portfolio. It's like screaming at an umpire at home through your television. It's not going to do anything.
Listen, you can't become the chart whisperer and hope it works out. But the reality is, you know, the market's going to find support and resistance levels on an intraday basis, and then triggers are going to happen because support or resistance breaks. When you look at this from an intraday perspective, yesterday on the cash open, you see this kind of just this consolidation type period between 3060 and 3040, fairly tight consolidation.
Really tight for these market conditions.
Oh, absolutely. Once it breaks here, you see that ramp coming into the close. And a lot of that is based on, not on, you know, people, mom and dad buying stock on a daily basis. Obviously, that's based on algorithms, right? Once it breaks out of this resistance level, it drives the price up. And then obviously the market closes right here. Market behaviors change when the market closes. And then on the overnight action, when Europe kind of opens up on the overnight action, you see this downward movement in price. Consolidation happens before the stock market opens. Once it violates that support level, you see this quick movement to the downside. And, you know, and one of the reasons I bring this up is because I've been talking about how Keith King in our coaches show is going to be teaching, you know, futures trading over the course of the next 4 weeks. And I do have it confirmed, guys. So get excited for this. I do have it confirmed that Keith King over the next 4 weeks is going to be teaching trading in the futures market in our coaches show. In week 1, we're going to talk about, just trading futures in just the introduction of trading futures. Week 2, we're going to talk about futures as a day trading vehicle. Week 3, we're going to talk about futures as a hedging vehicle. And then week 4, we're going to talk about futures as in trading options on futures. So this is going to be something we're really excited about for our pro community of tackle trading. And, and I hope it's going to make a lot more sense, everything we say on a daily basis, as Keith comes in and does that. So I'm excited to be there. You guys should be excited. But I was talking to Keith King yesterday, and we had an hour conversation on this, and he was basically saying the exact same things we're saying here today, is, dropping that time frame down and really focusing on these intraday support and resistance levels. And obviously, as you break support levels on an intraday, you're going to go find that next level of support. And when you look at that next level of support, and this is just how everything happens. When you violate a support, it's going to go find that next level of historical support. When you violate that 30-40 support level, it's most likely going to go find this next support level down here. And that just so happens coincides with that very, very significant whole number in 3,000. So, literally as I've been talking here, the S&P is down 7 more points, because that's what happens. When resistance breaks, it finds the next resistance level. When support breaks, it finds the next support level.
And the only chance from it, and this is some really advanced moving average stuff, the only chance that it has of not finding that, the highest probability is that you find that next support level. The only chance is if you get a short-term momentum boost in which it catches moving averages on the 1, 2, 5-minute chart and swings algos and day trading enough to create a new support level. Intraday charts are fascinating right now, Matt. It's where all the action is. I mean, we've started, with the market, look at how fast things drop once support levels break in the short term. As we're talking right now, it's just, intraday charts are really, really fascinating. And people that are learning how to read intraday charts are learning techniques that they will be able to use in their trading the rest of their life. Can you imagine? Do you think we lived on anything but intraday charts in the lounge this morning, Matt?
Oh, no, I guarantee you're on 15, 30, and 60-minute charts.
We all lounge long.
You're not going to get a good technical read on a daily chart right now. You're just not. It's too random on a day-to-day basis. All the action is being done at certain time frames in the marketplace, and these certain time frames are when, if you understand how the international markets work, these certain time frames are always based on when certain economic systems open up. And so, like when I was talking to Keith last night, it was right before the mastermind group, so it was right around 7:30 Eastern Standard Time. And I asked Keith what he's doing. He's like, well, I'm going to be in front of the market in about 30 minutes from now, because that's when Japan opens up. And when Japan and China opens up, a lot of times in that 8 o'clock, 9 o'clock Eastern Standard Time, you start to see price movement happen. And then, 4 hours later, when you get into or 5-6 hours later, when you get into the Eurozone and it's 8 o'clock in the morning, 9 o'clock in the morning in the Eurozone, in Frankfurt and out of Germany, and London out of the UK, you start to see price movement. And then when you start seeing the futures start to really kind of kickstart about 8 a.m. in the morning, and then obviously with the U.S. exchanges opening up. So there's certain time periods during the day where we do see that price movement really kind of happen, and it's all done on intraday charts. Nobody's looking at a daily chart trying to get a swing trade here.
Absolutely
Nobody is. Because it's like Keith told me yesterday. He goes, Matt, why would I be looking at a day chart, looking at a swing trade, when I can make the same type of money in this type of volatility on an intraday chart, right? And so when you're looking at this from a daily perspective, just get used to this, guys. We're going to see up days where it's like Dow's up 1,000 points, down days, Dow's down 800 points. That's going to happen in these types of volatile, moments. And I talked about yesterday how this market right now really kind of reminds me of that European debt market in July and August and September of 2011, where the market swung on rapid swings up and down dramatically based on just the daily cycle of when the news came out. And that's just something we need to get ready for on a daily basis. And this does not feel like we're in V-shaped recovery mode the same way we did in 18 in December of 18 and January of 19. this feels like it's going to be a volatile ride, and we need to buckle our seats and get ready for it.
And Matt, something that we kind of talked about in pre-production, and I want to allude to it and then pass it back to you. One of the reasons I don't see this as a V-shaped recovery is because of the lasting effects of coronavirus. So, yes, coronavirus and everything goes down, but the effects that it's had on, supply chains and shipments and things of that sort, those disruptions are not going to go away as quickly as the virus might. They're not going to disappear.
The two biggest concerns right now from an economic perspective is supply chain economics. Okay. That's not just going to get up and running overnight. That's a big issue. And that's one of the reasons we're seeing many companies in the stock market revise their guidance, lower their guidance, or remove their guidance in general, is simply because we don't know the extent of that problem yet. We've only seen one data point really from a PMI number out of China, and that was last week, and that was disastrous. We don't know yet the extent of the problem. But a bigger problem, and I want to get you guys to take on this, is one of the reasons, and Keith and I were talking about this last night, but one of the reasons that this market has been very euphoric over the last few years, despite a trade war and so on and so forth, is because consumer confidence has been high, consumer spending has been high, retail sales has been high. The consumers, which account for upwards of 70 to 80% of economic data, they have been spending their money and using their debt to do what consumers do best, and that is to buy stuff, right? Well, guys, what happens if the consumers start to pull back a little bit? That's the second concern. So the first concern is supply chain economics. The second concern is you can't force a consumer to get on a cruise ship. Monetary policy and fiscal policy doesn't fix that problem. You can't force a consumer to get on an airline. That's why United Airlines United Airlines today literally is stopping travel within the United States at certain hubs, not because of the fear, but because just of lack of demand from consumers and businesses and so on and so forth. So if this thing has a lasting impact, you are absolutely going to see consumers pull back. You're going to see businesses pull back. You're going to see purchasing orders pull back. And that's what causes a recession. And the recession here, the risk, I'm not saying it's going to absolutely happen, but the risk is real.
Now, we've been talking about that for 3 weeks, Matt. Like the economic impact to supply chains, to consumer behavior. This is something that we have been consistent on for a while now. And you're seeing it manifest. I mean, look at South Korea. Seoul is a bigger city than New York City. And if you look at pictures of the streets,
it's a ghost town, Mark.
It is startling to see the economic shutdown that has occurred in Seoul. Now, obviously, consumer behavior in Seoul, those stores, those places of business, they're not going to do very much business compared to what they have. And that's the economic lingering impact that occurs from a consumer standpoint. And right or wrong, you could say that the coronavirus is overblown. You could say that the government is underreporting it. But whatever it is, the government's actions are, you would think, directed at not altering consumer behavior in the United States. Because if that happened in the United States, I mean, what, tens and tens of thousands of restaurants, tens and tens of thousands of retail stores, tens and tens of thousands of places of business would have their own version of what is happening to the cruise ships and airlines right now.
Quite frankly, that's why you're seeing the revision of guidance, is because these corporations are seeing the changes in consumer behavior. They're seeing the changes in supply side economics, and their guidance is actually reflecting that. We've seen it across the board over about every industry. And yet, obviously, there's going to be certain industries that are going to be impacted far greater than other industries, right? I mean, when you're talking about cruise lines, when you're talking about casinos, and you're looking at, say, the market, what is the market down right now? The market's down from the absolute highs. What are we down? We're down about 10, 12% right now, depending on what index you're looking at. But when you look at some of these other industries, that have actual impact from a consumer behavior perspective, look at Wynn Resorts right here. Everybody knows that these casinos like Wynn Resorts are going to see less traffic, less revenue. They're down 40% off the highs, Mark. When you look at MGM, they're getting absolutely spanked right now, and just literally just momentum trading on the downside.
Will you back that out to like a 10, 20-year time frame to look in reflection of where price is right now? I mean, you have to go back 5 years to see MGM at these price levels. And who's buying?
We're violating another major support level.
Like, who's buying these areas of the market? The lows you could see in airline stocks, in casino stocks, in cruise ships. I mean, it reminds me of banks and insurance companies in the middle of the financial crisis. Everything got hit hard, really hard. But you had like what? Citibank. I mean, they were in the pennies. They were like $1.
Well, and let's talk about that for a second, because when markets do go through bear markets and we see recessionary data and so on and so forth, not every area and space of the market gets impacted the same, right? And it's about what recovers faster. And when you go through these types of scenarios where you see massive economic upheaval, you see, everything initially goes down. Everything does. Even utility stocks go down, because when fear grapples the market, everybody rushes to hit the sell button on everything they do. It's about what recovers sooner. When you looked at 08, what caused the bubble was subprime. So what got hit the hardest? Bank stocks, right? What caused the bubble in .com was tech stocks. What got hit the hardest? Tech stocks. And so when you're dealing with now a Corona type situation where it's going to impact consumer behaviors, what's going to be impacting the most? Brick and mortar type retail stores, cruise companies, obviously, the airline industry. These areas of the market are going to be hit the most because consumers stop their purchasing, they stop their spending, they stop they lack confidence. And even if they will state in a public poll that they're not scared, I promise you they're at Costco buying stuff to get prepared for it.
And they're not flying to Italy.
Oh no. No, and quite frankly, we should probably shut down travel to certain areas that the coronavirus has really been impacted a little bit more than other areas. But at the end of the day, you're going to see certain industries and certain sectors simply be impacted a little bit more. And you asked who's buying Wynn Resorts right now? The answer is very, very simple. No one. No one's buying MGM. No one's buying Las Vegas Sands. Nobody's buying Southwest and Delta and United Airlines and American Airlines. Nobody's buying them because we don't know the extent of the damage from an economic and a consumer perspective.
No, and to put,
by the way, if Wynn violates $93, watch out.
Now,
and by the way, these are also shorting opportunities.
Yeah, but I want to play devil's advocate long term here, because most of my leanings in this whole coronavirus thing for 6 weeks now, or 5 weeks, however long it's been going, it seems like my whole life, have been to the bearish side, have been to the cautious side, have been to all of that. Let me flip the script and talk about long-term opportunity. 2, 3, 4 months down the road, there's a really good chance the Wynn Resort, MGM, cruise ships hit. If this continues along the path from a narrative standpoint, you're going to see some multi-year lows. If you ever get the worst of it is over in this, that doesn't mean the buying opportunity is that day, but there could be some really good long-term opportunities, just like there was in AIG, yep, just like there were in the banks in 09, where you have really, really, really cheap stocks. I mean, and let's talk about airlines for a second down the road. Let's say this thing gets really bad. We have to have airlines in our country as part of infrastructure. You can't have a modern society without transportation. Does anyone think for a million years government's not going to come help these companies out?
No, of course not. They've already written the check.
Yeah, and so like
the reality is that the most likely scenario is this doesn't and when I say most likely, maybe it's 60, maybe it's 70%. I don't know the exact probability, but most of the time when these situations happen, whether you're talking about a disease or whether you're talking about economics or whether you're talking about politics, most of the time we overreact as a consumer base to the situation in real time. We don't know historically if we're truly overreacting until that history does, or that future does play out, and we actually see the data and have historical perspective. But many times when these situations do happen, they do create a buying opportunity. And I see Stephen talking about SARS and MERS and H1N1. The difference I do believe in those situations, SARS happened in 2002, 2003. The market was already down 50%. The central bank had a 2%, or excuse me, a 1% interest rate. They had already lowered their interest rate, and they were doing massive economic stimulus programs coming out of 9/11. And so that to me is a vastly different scenario on SARS than what we're dealing with at the market being an all-time high. When you're talking about H1N1, H1N1 was a massively bigger issue than what we're seeing with the coronavirus. You're talking about H1N1 when you're talking about millions of people were impacted by H1N1. Hundreds of thousands of people died based on H1N1, and that happened in 2009. And what happened in 2009? We were coming out of the market crisis of 2008. The Fed went to 0% interest rate policies, and they were literally, injecting $1.7 trillion, not billion, trillion dollars in freshly minted new money called the newly creation of quantitative easing. So I find it very difficult for me personally for me to compare SARS and H1N1 with what we're going through in 2020 with COVID-19, because simply the market is at an elevated level. PE ratios are an average of 31. You're talking about after 450% price appreciation over the last 10 years, and the central bank doesn't have the monetary ammunition, to the same way they did in 2000 through 2002, and the same way they did through 07 and 09. So to me, it's a different situation given where the market's at right now versus where the market was at back then.
Oh, it's an absolute apples to oranges type scenario. I mean, because valuations don't matter to the market until they do. And in 09, people were assuming that companies weren't making any money, that it was a total disaster. So like any good news is going to lift it up. I mean, the valuations are everybody.
Well, also, let's face reality. Everybody in 09 had already sold their stocks. That's the truth. That's why the market was down 58%. Is everybody had already sold their stocks in 2002, 2003? The S&P 500 is down 49% in that capacity. The NASDAQ was down 85% in that capacity. Everybody had already sold their stocks.
I mean, and that
Nobody
is a critical
sold
point.
so far.
At the point H1N1 hit, the only people left in the market were the people that were never going to go away no matter what happened. The market was going to go to zero or not, or true value investors. Like everybody that was going to get shaken out by fear, they got shook out.
They were already out.
And
they were already out.
And you're not even like close to that today. Like, and
no, we're down 10% off the highs after a 450% price appreciation.
Hey, Matt, it's much easier to shave the first 10% than it is to shave 10% after you already had a 50%.
It's true.
We can all agree that. Matt, will you drop down to a 5-minute chart? I think we're forming some intraday, like short-term little micro resistance that's going on right now. And so like what you will see from a technical standpoint is during these legs down, and is there any way you could put a 9 EMA on there?
Mm-hmm.
My girlfriend is feeling very neglected at the moment and wants a 9 EMA.
She is, the 9 is flirting with the S&P right now. Looking at it here on my screen. Are you on a 15-minute or a 5-minute chart?
I'm on a 5-minute right now.
And you don't have to change because it defaults to the 9 because that's what computers do.
Because that's your girlfriend. What color do you like your 9?
Of course, pink. Come on. Like,
okay.
I
thought she was yellow at one point.
Mark?
Oh no,
like hot pink.
Okay, that's purple, and like
that is pink.
All right, so from a technical analysis, and these are the type of lessons. If you're a pro member, you're going to get a lot of these type lessons coming up because we are increasingly talking about day trade and trying to understand charts. So what you have in this situation is you have like a breakdown of support, and then you have a halt. And what's going to come up now is going to be an intraday pinch. Now, what happens in this situation is that short-term support forms. Now, short-term support can form at a variety of times, in a variety of different situations. And so the whole length here that we've been talking on the halftime report takes a leg down, and then immediately a support level forms. Now, what you have from an algorithmic standpoint right now on price, how price works, is that you have support form, but then after this sell-off that's occurred for an hour or so, and what is going on here?
Oh, just keep talking. I'm putting an order in underneath that support level just to show
Okay.
people how.
There you go. Very, very good education there. So you have these short-term support levels form on these really small time frames, 1 minute, 2 minute, 5 minute. They all can give you the same type of reading. And so you have these support levels that form, which are very, very common, very, very, very common for short-term support to occur. But now let's put ourselves in the mind of an algorithm. During these sell-offs, what you have is you have moving averages that are falling, that pressure down. But when you have some bigger drops, it takes a little bit of time for moving averages to catch up, all right? So that you have these lulls in time where moving averages are falling and they're not catching up. And so what you have now is you have critical pinch situations. Now, when I use the term pinch, think of it as a compression. So you have two technical factors compressing against one another. One, short-term horizontal support, and two, falling moving averages that act as levels of resistance. Now, what is really, really critical in the minutes that come up from a price action to understand where price is going to go is what happens when they compress upon one another, where there is real compression, where support builds, holds, but then you have falling moving averages creating a narrower and narrower and narrower range for price to fluctuate. You're going to see this playing out on 2 minute charts, on 3 minutes, on 1 minute. And algos are doing all these calculations. Day traders are doing all of this anticipation, like what was Matt's first instinct. If the support breaks,
Put an order under support. Now,
support.
And Mark, support is forming, you obviously can see look at that break.
Well, there's still
as support is forming. You can obviously have support hold and create a reversal type pattern. And that's why when support is forming, you don't short at support. You wait till it violates support.
And that's why it's compression. Because what I teach people, because while there is some statistical evidence that shows that compression patterns break in the direction of the moving averages. So if moving averages are floating up, it will break in the moving. But what you really want to do from a new standpoint is wait for the compression pattern to form, wait for the signal, and then you see another leg down. Or then you see support hold, catches the moving averages, closes above them, and you can see a reversal pattern form. But waiting for those compression patterns to form, play out in momentum situations are oftentimes the key to the next leg of the momentum. Moving averages can be really, really, really powerful in momentum environments, which oftentimes happen in day trades, right? So,
well, and I agree with that. But in terms of reading that intraday chart, I think the most important aspect of reading that intraday chart is literally finding those horizontal support and resistance levels and waiting for those levels to either break resistance or break support. And when you're looking at this, you see that horizontal support level form at 30.40. What happens when it breaks? You see that big candle on the downside. And the reason you see that big candle moving down, 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 down is because it's not just us that is putting orders under support to either short the market or number two, just to get out of a long trade, right? Because if you're buying the market at a support level intraday, where's your stop loss? Your stop loss is right underneath that intraday support level. If you're looking to get out of that position, obviously you're looking at putting a stop loss right under support. If you're looking to short the market, obviously that's, that order to get into the position is right under that level.
Every short seller in the world is like, Mark, you need to do more of those, because as soon as you started giving that lesson, so the short-term support broke like on cue. But that's what happens. And as a day trader, as a studier of intraday analysis, you see these things happen all the time. And learning how to develop systems learning how to develop trade techniques, learning how to discipline and with precision do these. It's not as hard as one would think, unless you, but you have to have discipline.
We said it yesterday. I mean, in the step system, which is, of course, we teach over there at Tackle Trading, it's our swing trading system. In the step system, there's 8 hours of videos, okay, in the step system. And everything that we teach in the step system can be 100% applied on an intraday time frame, right? An intraday time frame. And we get that question quite a bit about, all right, so, you know, how do you day trade? Well, you day trade the same way you swing trade. You're just doing it on a 15, 30, 60-minute chart. Now, for me personally, I would not be triggering off a 5-minute chart, not in this market environment. I would be looking at a 15, 30, and a 60-minute chart to really get your understanding of those intraday prices.
In fact, we talked about that exact principle in the lounge this morning, Matt, where we talked about, especially in early stages, those longer time frames help you make better decisions, because price action is so fast in today's market. In the last 2 weeks, it's so fast. You're prone to make rookie mistakes because you get freaked out because price movement happens at any given second.
Yeah.
Longer time frames, even 15 minutes.
I don't even look at it like in a normal condition, Mark. If I'm day trading, I'm looking at a 15 and a 30-minute chart. My favorite time frame is a 30-minute chart. That's personally my favorite. But that's typically what I'm looking at. In a volatile condition where you have a lot of, you know, even on an intraday basis, you have news that comes out that really dramatically can impact the price action. I think a 30-minute, I think looking at the trend from an hour perspective, triggering off a 30-minute chart is probably the better way to go right now.
But even if you're not day trading, understanding and getting a better understanding of how price movement occurs, from like how it occurs, I think makes you a really, really much better trader. As long as you're not like trying on the fly to like put all your whole account on, oh, I have a theory, I'm going to go do this right now. Well, yeah,
don't do that. Take your time, plan trade ahead of time.
Let me answer Steven's question, because I think it's a really, really good question. If your entry is right underneath that intraday support level, Steven, and you know, and again, I think the day trade here was the hourly chart when it broke 30.40. I don't think that the trade is when it broke 30.20. But if somebody's trading off a 5-minute chart and your order is under, say, 30.18, right underneath that 30.20, the candle low, 2 stop loss placements I think would be legitimate here. One would be an aggressive stop loss where you're like, I'm not willing to take any risk here. If it doesn't work immediately, I just want to get out. It would be right above the breakout channel. So when I reference the breakout channel, you're talking about that area of support, and I would put that at 30.20. So maybe you know, 30.22, 30.25, somewhere in that capacity. If you wanted to give it a little bit more room to work, I do think that stop loss should be right above that candle high right there at that 30.30 level. So aggressively, I think in a violation of support, you know, you're breaking out of that breakout channel of 30.20. You put that stop loss right above 30.20. Obviously, you're taking a bigger risk to getting stopped out there, but you're taking less risk. But if you wanted to give it a little bit more room, getting a stop loss above that base between 30.20 and 30.30, that would be above 30.30. Now, that's a 10-point range, guys, which is a fairly big range, even on a 5-minute chart. But that's what you're dealing with in this type of market where the ranges are so big. So aggressively, I would say above the breakout channel at 30.20, conservatively taking on a little bit more risk, but having a higher probability, I would suggest above 30.30 in that.
And the way that you handle these bigger ranges is you decrease your position size to where your loss and your pain threshold is still the same.
That's a great point, Cody.
Yeah, you
stop
decrease
making,
your position
you know,
size.
Cody, if you keep making smart points, how am I supposed to consistently make fun of you?
You'll find a way, Mark. I believe
He'll find a way.
But yeah, position. I mean, Cody, say that again. It is so spot on.
Yeah, with the broader ranges like this that, you know, increase that risk, make sure you decrease your position size to where your overall risk is the same percentage that you have with your pain threshold. So if you risk no more than, you know, 1% per trade, and the range of where you need to put your stop losses is increased, then you decrease your position size. That way it's, let's say you cut it in half. If the position size is halved, then the risk is going to be halved.
Which allows you to put the stop loss above 30-30 where the stop loss really should be.
Exactly. If you can't put the stop loss where it should be, then you have too large of a position.
Well, and honestly, that doesn't just go to day trading. That goes to swing trading as well.
It goes
Like,
all of it.
If your standard position size is, say, $2,000 into a trade, and you can't put the stop loss where it needs to be, all you need to do is drop your position size to handle the same type of risk profile. Right?
The thing about day trading and we've tried to make this point increasingly over the last couple of days, is the same techniques on swing trading are applicable as far as money management, as far as risk management, as far as reading technical signals on chart. It just happens at a faster pace, but those principles are the same, which makes learning how to day trade on the fly difficult, right? Because you're having to learn, like, it's not, don't be out there and be placing your first day trade today based on limited tidbits, because we're only giving you tidbits here. Day trading and trading in general, I mean, there's a lot of material, but those same principles that we teach people in the step system for swing trades, like, look at this day chart. If this was a 5-minute chart, the principles are the same. And if we're looking at a 5-minute chart, the principles are the same. Technical analysis is the same, just happens at a more rapid pace. There are different variables that occur, but support is support, resistance is resistance.
If there's one big difference between day trading and swing trading, it's understanding the 24-hour cycle in terms of the Forex and the futures market. And so if you're swing trading, it's really kind of about, technical analysis, daily charts, support and resistance, pattern recognition, position sizing, all of those types of concepts. But if you are going to day trade, you absolutely have to fundamentally understand how price behaves around that 24-hour cycle, which means you need to understand when banks are open and when banks are closed.
Well, even the intraday cycle, I mean, the 2 hours after the market opens, there's a different pattern than the lunch hours. During the lunch hours, people go to lunch. The traders go to lunch. Wall Street, they go to lunch. There's not as much movement there in the hours leading up to it. So there's even cycles within the intraday that if you're going to, in addition to understanding the 24-hour cycle, when banks open, banks close, you also need to understand the factors that happen even smaller than that. There's multiple things that you need to understand from time frames and rules and all of it.
Yeah. And my hope, guys, is that our community over the next 4 weeks is getting into those coaches shows on Tuesday night, listening to the great Keith King and learning how to do this. Because obviously in the halftime report, our job is to go through the daily routine, read the market indexes. We're never going to remove the teaching because that's who we are. But if you truly want to learn this stuff, get into the step system, watch those videos, get into the coaches shows, watch the great Keith King, go about how he does this, because that's how you learn. You got to go through the learn.
And while I am not the great Keith King, and even my confidence and hubris would not put myself on that level, we do a fair amount of this on the Traders Lounge this week too, because we always match what we're teaching to market conditions and the way that people can best take advantage of whatever the market is. There will be a time where we talk very little about day trading and day trading techniques. It's just what's dominating right now. It's just what's much more applicable right now.
6 months ago, we were talking about investing in swing trading and cash flow. We're talking about what works in this market. So, moving on from obviously the market indexes here, obviously a little bit of a down day. It's going to be volatile. Mark, I want to get your take. Cody, I want to get your take very quickly on the dollar here. The dollar obviously breaking another support level at 97, coming into 96.5. Cody, what's your read on the dollar here? I mean, you do the Forex report for tackle trading. You day trade currencies quite a bit. What's your read on the dollar?
This is exactly what I expected. I loved when it had that bullish retracement that did not trigger. And that's another reason why, you follow those rules, because it looks beautiful. And then, as coronavirus and things started coming out, and the likelihood that the Fed was going to increase or cut rates, the increase in the likelihood that they were going to cut rates started going up, we started seeing the dollar break down out of that pattern. Then they did the surprise cut of 50 basis points. That's also going to, hurt the dollar and devalue it. So exactly the drop that we see in the US dollar is exactly what I expected. And on an intraday chart, just like you just showed there, very, very simple pattern. You see that support, it broke. Then you got to break down retracement, which is my favorite pattern, because then, if you miss that first break, don't go chasing trying to grab it. Wait till it comes back and gives you the second signal, and you can play it again. And it came right up into Mark's girlfriend, the 9 right there, before it turned around.
And I don't do a ton of day trading any longer, but I will tell you my favorite pattern in a day trade is a violation of support. I don't love retracements. I just don't. I love consolidation and then break. And that's what you're seeing on the dollar here. You see that consolidation and then the break. This retracement is so hard to predict. It's just so hard to predict.
Over the last
consolidation and the break.
The last 8 days, Matt, I'm getting back to my roots of day trade. I mean, it's funny. It's like I really enjoy day trading a lot.
We absolutely do it more in this environment than in a normal environment.
And so like I've been busting out old data sets. I've been applying them to current market conditions. I've been re-energized on day trading. It's like, and you don't know how long this could last, but this could be a prolonged situation where you go back and look at that European debt crisis, and that thing lasted 2 months.
That's 2 months.
It was wild swings. And it's like, while I'm waiting for good opportunities on oil, while I'm waiting for good opportunities in different commodities, while I'm waiting for good opportunities to boomerang style stocks, it's like, I'm not going to do nothing.
Yeah.
You got too much knowledge, you got too much experience. It's like, so day trading is going to be more and more prevalent I think lots of traders. I honestly
do not believe if anybody is saying this is a great buying or a great selling opportunity in this condition, when there's too much uncertainty and too many unknowns about what's going to happen 2 weeks from now, I don't feel that traders who are looking to swing trade can get a good edge right now. I do not believe that, but I can get an edge. I can get an edge on a 30-minute chart. I can get an edge on a 60-minute chart because it's much easier in this market condition to say, okay, if the support violates, it's going to retest that next support level on an intraday chart. That's very difficult on the day chart. But you did mention crude oil very quickly, Mark. Vienna this week is important. OPEC is meeting today and tomorrow with the ministers of OPEC and the non-OPEC countries there in Vienna. And the expectation, Mark, is a 1 to 1.5 million barrel reduction in crude oil production coming out of OPEC. Now, obviously, there's going to be discussion on who's going to make those cuts, and basically, is Russia going to play ball here? But oil right now is not responding positively to what we're seeing now. Now, most likely, this is just because the market and whatnot. But you are seeing those intraday support levels being violated. You're seeing, momentum start to pick up on the downside. What's your read on crude oil here, and what's your read on OPEC?
I worry that the great buying opportunity in oil is so far in the distance that oil is going to become day trading only in the short term. And that breaks my heart, because boomerang long-term opportunity, which there will be one down the road. The only way there's not a great buying opportunity in oil, Matt, is if we literally all die from the coronavirus.
I agree with that.
But
that buying opportunity is not today.
Yeah, and if we assume there is going to be that opportunity, but to even speculate what the demand shock is going to be for oil, you have to know the economic impact, because the coronavirus could not hit the United States hard and oil still be tremendously impacted by other parts of the world. So oil has an extra sensitivity, and
oil is the economy, Mark.
Prudent traders on oil, trying to guess where the bottom is on oil is maddeningly irresponsible.
I'm not trying to guess the bottom here. I'm looking to short here.
Yeah, no. And once again, I would approach that from a day trading standpoint. You have a great swing trading setup to the downside. I would just take that great swing trading setup and apply it on short time frames.
And you know, I know Cody does this in the Forex a lot, that he will trigger into a day trade, and just based on the momentum of that trade, he might turn that into a swing trade carrying it 2, 3, 4 days. But you trigger on that intraday time frame, and then just simply through adjustment of stop losses, that certainly could turn into a swing trade. And I absolutely agree with that. It's really tough in the face of OPEC. Right. In the, you know, Friday's, you know, coming up really soon, and nobody wants to carry short-term trades through the weekend. So I don't think there is a swing trade here, but I certainly see prices depreciating from these levels.
I think that is a safe bet to speculate.
And finally, the one we all love, Mark, gold. You know, gold has obviously had a pretty good, you know, week this week. Obviously, after last week's margin call craziness that happened later last week on Friday, found support at 1,600, and it's up 68 points since that time frame. You are breaking out of, you know, daily resistance levels. You're breaking out of intraday resistance levels. Obviously, with what the Fed's going to do and so on and so forth, you're going to see price appreciation in the gold market. What's your read here on gold, Mark?
I mean, go to a weekly chart. The one thing in last week's silliness on gold is that you didn't see that my girlfriend violated on the 9, came down to the 9, bounced off the 9. Gold is one of the few areas in markets right now where longer term position signals are applicable. Because it's to the upside still, right? And price tends to behave in a more orderly fashion on longer time frames when things are trending up. There's a lot more order to it. Obviously, with Fed monetary policy, with just that sums it up. I mean, the upside of the gold is there's a lot of upsides.
And obviously we could be wrong here, but how in the world in this environment with what the Fed just did and the fear that's happening from a global economic perspective due to the coronavirus, how in the world do we not test those resistance levels of 11,
Matt,
12, and 13?
And this is the thing about deciding how to, because Matt, you long used the phrase gold is a natural hedge against market volatility. I mean, a lot of tackle trading members with gold, one of the reasons they are not suffering is the teaching them how to evaluate gold over the last 14 months, and that has helped them just bottom line, even when they're long-term long stock in this situation. It really seems like, I mean, once again, you don't know the future. It seems really, really hard that 1,800 isn't going to get tested. Like
it
almost seems like, because I
get I'm a gold
it's
guy,
not going to be tested. I know.
I don't see the economic, the technical, or the fundamental reason why gold would not test 1,800. I mean, Mark, that was my prediction in the podcast, is that it would test 1,800 and then settle somewhere around 1,700 by the end of the year. And that was before Corona. That was just based on central bank easing monetary policy.
Yeah, that was just normal course of Fed operations. It seems really unlikely that 1,800, and if the coronavirus gets worse, you could be looking at all-time highs in gold.
2,000, 2,200, 2,500. I don't know, but the reality of the situation is, if there's one thing that will impact gold, it's Fed monetary policy and it's economic calamity. And those two things are happening right now to the same degree that we started seeing gold start price appreciating in the first place coming out of 2009. So to me, obviously, it's a little bit overextended on the weekly chart here, but that natural hedge against so many negative potential outcomes. Now, obviously, we might look back, and Cody and I were talking about it, we might look back 6 months from now, a year from now, and be like, well, thank God the worst didn't happen, right? But even if that happens, don't you still think the central banks are going to continue to cut rates and continue to quantitative ease and continue? I mean, Mark, just on Tuesday night, after this non-global, coordinated central bank action, just on Tuesday night, there was $120 billion worth of repo actions. $120 billion worth of repo actions just on Tuesday night. The Fed's balance sheet, regardless of the coronavirus, will continue to expand, which means you should own gold.
Yeah, no, I don't. It's hard to see the fundamental shift that stops the gold train. Like the fundamental shift to the stock train that was going up was this big, massive coronavirus situation that's developed over the last month plus. And so you had this huge fundamental shift that occurred. I mean, I guess
it's hard to find the argument, Mark, because there doesn't exist.
I mean, that's why when it sold off a few days ago, you and I were like, who cares? Like, that's buying opportunity. Like, it's just, how do you want to buy it? I mean, we were very, very clear on that, because when you look at it from a fundamental perspective, there's such massive movement.
I would love to hear the Wall Street, analyst paint an argument against owning gold right now. I would, I am a massive fan of Warren Buffett. Love Warren Buffett. I worship the altar of value investing in Warren Buffett, but I would love to hear Warren Buffett's argument against gold right now, because an argument against gold for the last 20 years has been it doesn't pay him an interest. It doesn't pay him a dividend. That's his only argument. So I would love to hear Warren Buffett's argument of why people should not own gold as a hedge against monetary policy, as a hedge against economics. I would love to hear that argument, because I do not believe that argument exists in this current situation. Now, if 3 months from now, the Fed comes off their quantitative easing, if 3 months from now we look back and say the corona was a fear and it scared us, but it didn't have massive economic upheaval, if in 6 months from now the supply chain problem out of China and the Asian zone gets fixed, all of those are big ifs. But I would love to hear the argument right now, given the monetary, fiscal, and political and economic condition, of why somebody would say don't buy gold. Because I don't believe it exists.
Well, man, I don't think it's existed for 14 months. Ever since the pivot, when
the Fed was raising interest rates, there's an argument, right? When the Fed is raising interest rates and when the economy is doing great, there is an argument against gold. But that argument does not exist when the Fed is lowering interest rates, increasing their balance sheet, and there's a risk to the global economy from a supply chain economic perspective.
It has not existed since Powell pivoted in early January 2019. It hasn't. We have been over this. Listen, become a pro member of Tackle Trading. You only hear a small sample of the overwhelming analysis techniques, everything we teach. We have a tendency to know what we're talking about. We live this stuff, we breathe this stuff, and we care about the information, the chart knowledge, the technical analysis teaching, the overall analysis of the members of our community. Well, we care about it for everyone, but we put extra emphasis on our community. Become a pro member at Tackle Trading. They're literally like, you don't get this type of honest analytical analysis many places in the world.
Well, and here's another honest response. Amy says, why won't the Fed put that repo money towards COVID-19 research and relief? You would think. But guys, how many times have I said the Fed doesn't represent the people, it doesn't care about the people, and the only thing they care about is the Wall Street institutions? That's it. Every policy they're ever going to do is to the Wall Street institutions, and that is all it is about, 100%. Yeah, so why do they put $120 billion in repo actions in one day? Why do they increase their balance sheet by $600 billion over the last 6 months instead of putting, and take it even further from that? Why don't we, listen, if the Fed represented the people, instead of bailing out Wall Street constantly, instead of bailing out corporations constantly, instead of applying corporate socialism constantly, we could actually provide everything Bernie Sanders actually puts out there and actually do fine. But that's not who they represent. They represent Wall Street. They represent corporations. And the sooner we as a consumer base wake up to the reality that our government does not care about us, and that our central bank does not care about us, and that Wall Street doesn't do the best for us, and our corporations don't do the best for us, the moment we will take control of our own financial and our own civil liberties again. So we just got to wake up to that reality, in my opinion.
Well, Matt, Jerome Powell sent me a Christmas card, so I think he cares about me.
Well, Jerome Powell did say six months ago in a meeting or in a policy statement that we care about the American people, but yet $600 billion later going straight to Wall Street, and yet 50% of Americans are living paycheck to paycheck and can't even afford a short-term increase in cost. So give me a break. Give me a break. It's silly.
The Fed is absolutely a morphed monster from what it was meant to be and what it is, or two wild.
The Fed is exactly what it was meant to be in the creation of the central bank in 1913. Rothschild said it best himself. He said in the creation of the central bank in 1913, he who controls the supply of money controls society. So if we want to think that the central bank is anything different than what it was created to be, and Thomas Jefferson, one of the greatest Americans of all time, said the biggest risk to a free society is the banking system. And he was talking about the European model of central banks that control populace, and that is, and so I worship at the shrine of Thomas Jefferson. I trust him. I don't trust banks.
Yeah, we shouldn't have had a central bank.
You know, central banks don't care about you. Your government doesn't care about you. Your political party doesn't care about you. Let's just be honest. You are a pawn in their larger schemes. It's true. You know who cares about you? You do. Your money manager doesn't care about you. The only way you can guarantee your money is being looked after by someone who truly cares about your interest is if you take control of your future. If you take the time to learn, if you take the time to apply, if you develop critical thinking skills,
Mike, just ask the question. How many of you guys here today watching this show at some point in your life have been let down by corporations, have been let down by government, have been let down by your financial advisor on Wall Street, who have been let down by something else? I just believe that we, as an individual, will always care more about ourselves than external forces will. And that's why we should always seek to have more education so that we don't have to rely on external forces to take care of ourselves. I am a capitalist. I'm an entrepreneur. I am a conservative. And I just believe that we as an individual are responsible to oneself. And it is not the government's responsibility to take care of me. It's not the central bank's responsibility to take care of me. And I need to do it for myself and for my family. And everybody else is the exact same way. And that's why you guys are here. That's awesome.
No.
All right. Send it out. Well, yeah. What a show. What a crazy show. Lots of teaching moments there. A lot of really good information. I absolutely enjoyed it myself. I hope you guys enjoyed it out there. And if you did, make sure you like this video. We're at 21 likes with 80 people still watching. Make sure you like this video. If you're watching it afterwards, give it a like as well. Subscribe. Tell any of your friends that are freaking out about the market and needing some advice and needing some help right now to come watch our channel and subscribe as well. And if you are viewing us for the first time over here on YouTube and you're loving what you're hearing, then make sure you click the link down in the description. You'll get a 15-day free trial and you'll be able to understand all the great benefits that our pro members understand. And there's a reason that our pro members have been messaging us over the past week saying, you know, thank you. Like I was able to do this and this and hedge my portfolio and fix that. It's because those pro members took advantage. They got the education and they're taking advantage of their own money because as Matt was just ranting on, no one cares about your money more than you. Well, maybe the IRS, but they just want to take it. With that, guys, we're out.